All right, hi class. So we are at week 3 now. We are going to be talking about stock valuation this week in chapter 7. So with that, let's get started here. In this chapter, we are going to learn about debt and equity and how to differentiate between the two. We're also going to discuss both common and preferred stock and their features. We're going to apply basic valuation models to stocks and describe the relevant cash flows and the impact of required return, and how the concept of market efficiency and how to value stocks using zero growth, constant growth, and variable growth dividend models. We're also going to discuss the free cash flow valuation model and book value, liquidation value, and price earnings or PE multiple approaches. And then finally explain the relationships among financial decisions, return risk, and firm's value. So with that, differences between debt and equity. What is debt? Debt includes all borrowing incurred by a firm, including bonds, and that's repaid according to a fixed schedule of payments. Equity consists of funds provided by the firm's owners, their investors or stockholders, that are repaid subject to the firm's performance. The voice in management. So unlike creditors, stockholders actually own the firm. They have voting rights that permit them to select those firms' directors and vote on special issues. Debt holders don't receive those voting privileges, but instead they rely on their contractual obligations with that firm to be their voice. There are also claims on income and assets. So stockholders' claims on income and assets are secondary to the claims of creditors. Because stockholders are the last to receive any kind of distribution of asset, they have a lower priority claim on that firm's income. Their investment is relatively risky, and they expect higher returns as compensation. So the cost of equity financing is higher than the cost of debt financing for that firm. And unlike debt, equity financing is permanent. It doesn't mature. It doesn't require repayment at any time. So stockholders recognize that they can sell their shares at any time in the liquid secondary market, but they can't know what that share price will be when they are ready to sell. There is tax treatment. So the U.S. tax code allows firms to deduct interest payments from income, which lowers their tax bills. A dividend payment to stockholders, on the other hand, is not tax deductible and doesn't reduce any of the taxes. So the tax deductibility of interest lowers the corporation's cost of debt financing, which is another reason why the cost of debt financing is lower than that of equity financing. So here are some of the key differences summarized in this table here. So characteristic voice in management: with the debt holders, there's no, but equity holders, yes. Claim on income and assets: debts are senior, equity is subordinate. Maturity: there is stated debt, equity, there is no maturity. And then tax treatment: there is an interest deduction with the debt holders on taxes for that firm, but there's no deduction when there's dividends paid out. So let's talk about common and preferred stock now. So common stock is ownership. There could be privately owned stock, publicly owned stock, or closely owned stock. Privately owned is owned by private investors. It's not publicly traded. Publicly owned is owned by public investors, and it is publicly traded. And closely owned stock is common stock of a firm that's owned by individuals or a small group of investors like family members, and they are usually privately owned companies. And then finally, there's widely owned. So this is the common stock that's owned by a lot of unrelated individuals and institutional investors. For common stock, we're going to be talking about par value. That's an arbitrary value that's established for legal purposes on the charter of that corporation, and can be used by finding the total number of shares outstanding by dividing it into the book value of common stock. Preemptive rights: those allow common stockholders to maintain their proportionate ownership in the corporation when those new shares are issued, and it protects them from dilution of ownership. We could look at, with preemptive rights, dilution of ownership. So again, that's a reduction of their previous shareholders' fractional ownership, resulting in the sale of new common shares. So preemptive rights that allow the common stockholders to maintain that without diluting their ownership. Dilution of earnings is kind of similar with that, except it's going to dilute their earnings from those sale of new common shares. And rights allow stockholders to purchase additional shares at a price below the market price in direct proportion to that ownership that they own. So for an example, Cuban Ventures Inc. invested $10 million to purchase 500,000 shares of a new startup company called Maverick Technology. After their investment, Maverick had 5 million outstanding, which means that Cuban Ventures owned 10%, which is 500,000 divided by 5 million of the company's common stock. So now Maverick Technology is growing rapidly. They need more equity financing. So they plan to issue another 1 million shares. With those preemptive rights in place, Cuban can purchase 100,000 of those shares, bringing their total ownership to 600,000. Again, 10%. So 600,000 divided by 6 million of the company's total after its second stock offering. If they don't want to exercise that right and decline to buy any new shares, their ownership percentage is going to fall to 8.33%. So again, that's the 500,000 divided by 6 million. With common stock, we have authorized, outstanding, and issued shares. So authorized shares, those are shares that a firm's corporate charter allows it to issue. Outstanding shares are those issues held by investors, including both private and public investors. And then there's treasury stock. Those are issued shares of common stock held by the firm, and they've often been repurchased by that firm. Issued shares are those shares of stock that have been put into circulation. So they're the outstanding shares plus the treasury stock. So here's an example. An abbreviated equity section of the Walgreens balance sheet at the end of their recent fiscal year looks like this. So their common stock, they have cent per par value. They have authorized 3.2 billion shares and issued 1.2 billion shares. So what do they have total is the 1 cent times the 1.2 billion, or $12. Their paid in capital in excess of par is 10,639. They have retained earnings of 35,815. So adding all those up together, you get 46,466. Now they also have treasury stock of 0.8 billion shares. So that is going to be taken out of the retained earnings to get our total stockholders' equity. So how many shares of additional common stock can they sell without gaining approval from their shareholders? They have 3.2 billion authorized, 1.2 issued, and 0.8 billion of treasury stock. So we have 0.4 billion shares outstanding. So again, you're going to take the 1.2 minus the 0.8 to see what's outstanding. And they can issue an additional 2.8 billion shares. So that would be the 3.2 billion minus the 0.4 billion outstanding, without seeking any of the shareholders' approval. So it can include, it includes the treasury shares currently held, which they can reissue to the public without obtaining shareholder approval as well. There are also voting rights. So there's proxy voting. This is a voting by a party designated by shareholders who want to retain ownership of their shares, but they're willing to pass that voting right to someone else. There's a proxy statement that outlines the issues coming to vote at a meeting. And then there's a proxy battle. That's an attempt by non-management group to gain control of that management or influence management by soliciting a number of proxy votes. There's also super voting shares. So this is stock that carries multiple votes per share rather than one single vote per share. This is typically not seen on regular shares of common stock. Non-voting common stock, it carries no voting rights. So they're issued when the firm wishes to raise capital, but doesn't want to give up any voting control. There are also dividends that come from common stock. So the payments of dividends to the firm shareholders at the discretion of the company's board of directors. Most corporations are going to pay those dividends. They distribute them quarterly. And when they start paying dividends, they're usually reluctant to cut them or stop paying them at all. So cash dividends are usually the most common. So here's a matter of fact. A careful analysis of how firms responded to the dividend tax cuts obtained in the 2003 Jobs and Growth Tax Relief Reconciliation Act found that firms dramatically increased dividends soon after that law was passed. One interesting comparison involved the tendency that firms never paid dividends had started to pay them. In the quarters leading up to the tax cut, only about 4 firms per quarter began paying dividends. But in the quarters immediately following that passage of that new tax law, 29 firms per quarter announced that they were going to start paying dividends. Similar increases occurred in firms already paying dividends, with nearly 50% of all dividend-paying firms announcing that they would increase their dividend payments by 20% or more after that tax cut became law. But something important arose. Corporate earnings jumped at the same time, so whether those dividends rose to tax policy or due to improving their corporate profits remains a matter of debate. With common stock, we can also look at international stock issues. So the American Depository Shares, or the ADSs, Those are dollar-denominated receipts for the stocks of foreign companies that are held by a U.S. financial institution overseas. The American Depositary Receipts, or the ADRs, are the securities backed by American Depositary Shares, those ADSs, that permit those U.S. investors to hold shares of non-U.S. companies and trade them in U.S. markets. And then we can look at preferred stock. So while most corporations don't issue preferred stock, some of it is in heavily regulated industries. So preferred stock gives their holders privileges that make them senior to common stockholders. They receive periodic dividends that are fixed, and either they are a percentage or a dollar amount. We have a par valued preferred stock. This is a stated face value that's going to be used with a specified dividend percentage to determine what the annual dollar dividend is. And no par preferred stock has no stated face value, but it's got a stated annual dollar dividend. Preferred stock is often considered what's known as quasi-debt. So much like interest on debt, it specifies a fixed periodic payment or a dividend. But unlike debt, preferred stock has no maturity date, and its preferred stockholders cannot force a firm into bankruptcy if that firm misses the dividend payment. Those preferred shares have higher priority claim on the firm's current income than do common stockholders, and are usually given preference over those common stockholders when it's time to liquidate assets in a legally bankrupt firm, although they have to stand in line behind the creditors. Preferred stockholders don't normally have voting rights, but they can elect a member of the board of directors. So what are some of the features of preferred stock? We have a certificate of designation. This is an agreement that's similar to bond indenture that specifies a variety of features of a preferred stock. There are sometimes restrictive covenants. They could be including provisions about passing or skipping dividends, the sale of senior securities, mergers, sales of assets, minimum liquidity requirements, and maybe even repurchases of common stock. There's cumulative preferred stock. So this is preferred stock where all unpaid dividends are in arrears, along with the current dividends. Those have to be paid before dividends can be paid to common stockholders. Non-cumulative preferred stock is preferred stock for paid, unpaid, or past dividends that don't accumulate. There's also a callback feature. This allows the issuer to retire any of the shares within a certain period of time at a specified price. They also have a conversion feature to allow those holders to change each share into stated number of shares of common stock. So with that, we have to look at common stock valuation and market efficiency. So because the flow of new information is continual and that content of information is unpredictable, otherwise it wouldn't be considered new, stock prices fluctuate. They're always moving towards a new equilibrium that reflects the most recent information available. This is known as market efficiency. The University of Michigan produces a monthly survey measuring consumer confidence, and that survey routinely causes stock prices to move when it's released. So in June of 2013, there are various news organizations that reported that Thomson Reuters had a contract allowing it to distribute information about the monthly consumer confidence survey to its clients through a conference call 5 minutes before those survey results were posted on the website for that university. The contract contained another provision that allowed Thomson Reuters to distribute survey results electronically to an elite group of clients at 9:54:58 a.m., 2 seconds prior to that conference call. The 2 second of lead time over the rest of the market could allow those clients to trade stocks before most market participants even learned about this new information. So with that, we need to look at behavioral finance. This is a growing body of research that challenges the efficient market hypothesis and argues that psychological factors could cause investors to make systematic errors that might influence that equilibrium for those stock prices. The value of a share of common stock equals the present value of its expected cash flows. So this formula here in 7.1 is our common stock dividend valuation model, where P0 is the value of today's common stock, and DT is the expected dividend at the end of year T, and R is our required return on that common stock. This is our zero growth dividend model formula here. It's an approach to dividend valuation that assumes a constant non-growing dividend stream. So here's a personal finance example. From 2015 to 2020, Rocky Mountain Chocolate Factory paid a steady dividend of 48 cents a year. They paid that dividend in quarterly installments, but for simplicity, let's value their stock, assuming their investors get paid at the end of each year. What discount rate should we use? So we're going to explore that question in more depth, but let's just say that this chocolate is one of the life's necessities. So people are going to buy it whether the economy is booming or shrinking. So that makes this company a little less risky than the average company. If we think that over the long run, the required return on a typical stock is 10%, maybe their stock, 8% is a reasonable discount rate. So applying those assumptions to that equation from 7.2, we're going to estimate that that stock price is going to be about $6. So that's 48 cents divided by 0.08, which is our rate. In fact, the first few months of 2020, the actual stock price fluctuated in a range from $3.77 to $9.25, but the average price over that period was $6.90. So the constant growth model's prediction is not far off from the actual market price, though those price fluctuations suggest that investors' opinions about the model assumptions were shifting over time. That shouldn't be too surprising, seeing as how the stock reached $9.25 peak on January 6, 2020, about 3 weeks before the world shut down due to the coronavirus. By the time the US states were in lockdown, their stock price had fallen to the $4 range. So this could be attributable to some of the combinations of maybe the investors doubted that the company could continue to pay the 48-cent dividend, or maybe investors perceived that the coronavirus outbreak made that stock a riskier investment. So the required return increased above 8%. If investors expected lower dividends and higher risk, then the price of the company could fall a great deal. So other dividend valuation models we could look at are the constant growth dividend model. It assumes that dividends are going to grow at a constant rate, but a rate less than what the required return is. That formula is seen in 7.3. The Gordon growth dividend model is a common name for that constant growth dividend model, and it's widely cited. So we can see that 7.3, just kind of simplified, is in 7.4. So here's our example. The consumer products giant Procter & Gamble has paid dividends to stockholders for more than 100 years. To estimate that long-run dividend growth rate, we're going to calculate the growth of their annual dividend from 1999, which was $1.21 per share, to 2019, which was $2.95 per share. We assume that the historical average annual growth rate of dividends is a reasonable amount estimate for the future constant growth rate, G. So to find that historical average annual growth rate of dividends, we have to solve for G. So if we do the dividend in 2019 is equal to the dividend of 99 times 1 plus G to the 20th power, because it's a difference of 20 years, we're going to take 2019 and divide it by 1999 dividends. So that is going to give us, and then we're going to take out the 20th power there, 1 over 20, to get the 4.6 rate. So that's our growth rate there. We can use a calculator to help us find this by plugging in the N is 20, the PV is 1.21, the future value, we know that is 2,995 or 955. So we want to know what the interest rate is. So we have 4.57, which is about 4.6% from our calculation. So we're going to estimate that the dividend in 2020 D1 is going to equal about $3.09. It's about 4.6 more than the 2019 dividend. And a relatively mature, steady consumer products business, so we're going to assume a discount rate of 7%. So by substituting those into the equation 7.4, we can find that the value of their stock is going to be about $128.75. So given those values for D1, R, and G, their stock value is $128.75 a share. So compare it to their actual market price, which from January through April 2020 averaged about $126. Another dividend model is the variable growth model. This allows for a change in that dividend growth rate. So we have a couple of steps. Step 1, we need to find the value of the cash dividend at the end of each year, or DT, during that initial growth period through years 1 through N. So our formula is below. DT equals D0 times 1 plus G 1 to the T. Step 2, we're going to find that present value of the dividends expected during that initial growth period. And then step 3, we're going to find the value of the stock at the end of the initial growth period by applying the constant growth model from 7.4 equation to the dividends expected from year n plus 1 to infinity. And then finally, we're going to add all the present value components found in steps 2 and 3 to the value of the stock P0 given in this equation 7.5 here. So here we have the present value of dividends during the initial growth period, and then we need to add that to the present value of price of stock at the end of that initial growth period. One of the world's leading semiconductor companies, Broadcom, enjoyed a long history of spectacular growth. In their first 12 years as a public company, they increased total revenues by 34% per year on average. So with those growth opportunities, the company paid no dividends and they reinvested its earnings instead. But as the semiconductor industry matured, growth opportunities became scarce. So the company started paying dividends in 2010 and increased them rapidly over the next decade. In 2020, they paid $13 per share in dividends, an increase of 23% from the prior year. No firm can sustain double-digit growth forever. In the very long run, the limit on growth is the growth rate of the overall economy. So we're going to estimate the value of their stock using that 10% required rate of return and assuming that their dividends will grow over the next 3 years at 20%. After that, we're going to assume that the dividends continue to grow indefinitely, but at a much slower 3% rate. So step 1, we're going to estimate dividends for the next 3 years, 21, 22, and 23, based on that 20% increase each year from the $13 dividend. So we can see the dividend in 21 is $15.60, the dividend in 22 is $18.72, and the dividend in 23 was $22.46. In step 2, we're going to sum those present values of 2020 for the next 3 years from the values that we just found using a 10% discount rate. So our present value in 2020 for all the dividends is $46.53. Then we're going to find the value of stock at the end of the initial growth period of 2023. But we first have to calculate the dividend in 2024. So 2024's dividend is going to be $23.14. So based on that, with a 10% required rate of return and a 3% dividend growth rate, the value in 2023 of all the dividends paid in 24 and beyond is going to be the following equation. So D of 2024 divided by the required return minus that growth rate is going to be $330.57. Finally, we're going to convert that into a value share, into today's dollars, 2020 dollars, by discounting it at 10% for the next 3 years. So you can see that here, $330.57 divided by 1 plus 0.1 to the third power is going to equal $248.36. And finally, as specified in 7.5's equation, we're going to add the present value of that initial dividend stream found in step 2 to our present value of the stock at the end of that initial growth period in step 3 to find that their stock equals $46.53 plus the $248.36 or $294.89. So in the first 4 months of 2020, their stock price fluctuated a range from 168 to 325, which is an average price of 275. So that's pretty close using those assumptions. Another valuation model to look at is the free cash flow stock valuation model. This determines that the value of an entire company at the present value of its expected free cash flows discounted at the firm's weighted average cost of capital, which is its expected average future cost of funds over the long run. The free cash flow is the cash flow available to our investors, our providers of debt, or our creditors and equity owners after the firm meets all its other obligations. So it's particularly useful when we're valuing firms that have no dividend history or are startups, or when valuing an operating unit or maybe a division of a larger public company. So we can find the free cash flow stock model here in 7.6, where VC is the value of the entire company, and FCF is the free cash flow expected at the end of that specific year. And the RWAC is the firm's weighted average cost of capital. So WACC WAC is weighted average cost of capital. Because the value of the company is VC, It is the market value of the entire enterprise, all of its assets, and we have to find a common stock value, so VS. We have to subtract the market value of the firm's debt, or VD, and the market's value of its preferred stock, VP, from VC. So VS is going to equal VC minus VD minus VP. So here's an example. On December 31st, 2019, Ruth's Hospitality Group, which operates the nationwide chain of Ruth's Chris Steakhouse restaurants, reported free cash flow of $24.83 million. Over the previous 3 years, the company had been growing at a 7% clip, so we assume that maybe cash free flows will grow at that rate for the next 5 years before settling down to 4%. So we're going to look at a table that lists the expended end of year cash flows from 2020 to 24, along with other information necessary to complete our valuation. So step one, we're going to calculate the present value of each cash flow that they produces in the year 2020 through 4. We can look at the table 7.3 with those values. So for example, the 26.5 million free cash flow arriving at the end of 2020 is 7% more than the 24.83 million cash flow the year before. We're going to use a 10% discount rate, and we're going to see that the present value of the 2020 free cash flow is $24.15. We're going to use the constant growth model to calculate the present value for 25 and beyond. So because cash flows grow at a steady 4% rate over that time horizon, the free cash flow in 25 is 36.22, so $36.22, which is 4% more than the 24 cash flow of 34.83. So we can calculate the present value at the end of 24 using that information from 25 and beyond. So we're going to see that the future cash flow is that 36.22 and divide that by the discount rate, so 0.10 or 10%, minus the 0.04 growth rate. So we're going to come up with 603.67. Finally, we're going to value their start. So we need to discount that 603.67 to get our present value. So we're going to show that the present value is 374.72 million. And here's that table. This is 7.2 that shows the free cash flow over the years 2020 to 2024. And here's the calculation of the value of the entire company over years 2020 to 25 and beyond. So by adding up all the present values of the individual cash flows, we're going to get our total value, or VC. And we're going to see that that's $489, 49.07 million, sorry. And then finally, we're going to find out what our value stock is by taking our VC that we calculated in step 3, that 489.07, and we're going to take out the values of debt and any preferred stock that we have, and we're going to get 189.07. So we can see here that preferred stock is at 0, debt is at 300. So we have all this other data here that is listed to help us calculate those equations. So the value of the entire company is 49.07. Again, this is in millions. So the estimated value of their common stock is 189.07. That's taken by dividing the total number of 28.4 million shares outstanding to get a common stock value of $6.66 per share. So that's 189.07 divided by the 28.4 outstanding. Other approaches that we can use to value stock are called the book share. The book value per share. This is the amount of common share remaining if all the other assets were sold for the exact book value or their accounting value, and if their liabilities, including preferred stock, were paid at that book value. So here's an example. Lamar's company balance sheet shows assets of 6 million, total liabilities and preferred stock of 4.5 million, and 100,000 shares of common stock outstanding. So our book value per share is going to be our assets, 6 million, minus our liabilities and preferred stock, divided by our outstanding stock of 100,000. So we get $15 per share. So for many firms, the book value of assets is quite a bit less than what our market value is. So the book value per share is usually a conservative value on our stock. But investors believe that if the book value of a firm's asset is overstated or the value of its liabilities is understated, then their market value might fall short of that book value. We could also look at liquidation value. So this is the amount of common share remaining if all our assets were sold for their market value and liabilities, including preferred stock, were paid in full. So an example for that is Lamar, again, they found on investigation that they could obtain $6.25 million if it sold its assets today. So what is their liquidation value per share? So it's the 6.25 million minus 4.5 million divided by that outstanding stock of 100,000. So we get $17.50 per share. That's its liquidation value. The price earnings multiples. So the PE approach. It's a popular technique used to estimate the firm's share value. It's calculated by multiplying the earnings per share, the EPS, by the average price per earnings, the PE ratio for the industry. There are two main versions for this. There's the forward PE ratio that divides the current stock price by a forecast of earnings over the next year. And there's the trailing PE ratio, which uses earnings over the previous year or a trailing 12 months or TTM and then denominator. So here's an example of PE ratios for industry sectors from 2013 to 2020. The values and use of PE multiples is especially helpful when we're trying to value firms that aren't publicly traded, but they, want to use this approach for public companies too. It's forward-looking because stock prices are, and they usually produce higher valuations than the book value or that liquidation value. So here's an example. Anne Perrier plans to use the price earnings multiple approach to estimate the value of Lamar's company stock, which she currently holds in her retirement account. She estimates that the company will earn $1.90 per share next year, 2020. This expectation is based on the analysis that the historical earnings trend and on expected economic and industry conditions. She finds that the PE ratio for the firms in the same industry to average at 20. Multiplying their expected earnings per share of $1.90 by this ratio gives her a value of the firm shares of $38, assuming that investors will continue to value the average firm at 20 times its earnings. But there are some problems with the PE valuation. It's fast, it's easy way to estimate stock value, but they vary widely over time, as we saw in that historical graph. In 1980, the average stock price had a PE ratio below 9, but by the year 2000, the ratio had risen almost to 30. So using the PE approach in the 1980s would have come up with a lot lower estimates of value than 20 years later. By 2020, the average stock had a PE ratio of about 24, which is well above that long run average. So when using this approach to estimate stock values, the estimate will depend more on whether that stock market valuations generally are high or low, rather than whether or not that company is doing well. So we have to look at decision making when we're looking at common stock value. So changes in expected dividends. Any management action that would cause stockholders to raise their dividend expectations should increase that firm's value as long as stockholders perceive no increase in risk. So the decision action by the financial manager has an effect on the expected return measured by expected dividends and expected dividend growth, and the risk measured by the required return. So with this, it's going to have an effect on that stock value because stock value, again, is determined by the dividends divided by the rate minus the growth. So here's an example. Using the constant growth dividend model given earlier, we estimate that Procter & Gamble stock was worth $128.75. Imagine that P&G is going to announce a new product, and it's got to have a clear competitive advantage in the market. Current and prospective stockholders might not adjust their required return of 7% because the risk hasn't fundamentally changed, but they would expect dividends to increase. So say they're going to expect the next year dividend to remain at $3.09, but the expected growth rate thereafter will increase 4.6% to 5%. So if we substitute those values into our equation, the resulting share value is going to be $154.50 now. So the increased value is going to result from higher expected future dividends reflected in that increase in growth rate. We could look at changes in risk. So again, recall from chapter 6, that risk-free rate and the risk premium totals. Any action taken by the financial manager that's going to increase the risk shareholders have to bear they also have to raise that risk premium shared by shareholders and hence their required return. So again, increasing risk contributes to a reduction in value, and any action that decreases that risk contributes to an increase in value. So Procter & Gamble 7% required return from that risk-free rate of 1% and a risk premium of 6%. With that, we estimated their share value to be the 128.75. Now imagine that they're making a decision that without changing expectations to dividend, it's going to cause the risk premium to increase to 8% now. Assuming that the risk-free rate remains at the 1%, the new required return will be 9%. That's the 1 plus the 8. And substituting all of those values into our equation now gets us a new share value of $70.23. So again, we're raising that required return without making any increase in expected dividends, which is going to make our stock value decline. So obviously, this financial manager's action was not in the owner's best interest. We could also take a look at the combined effect. So a financial decision rarely affects dividends and risk independently. Most decisions affect both in the same direction. As firms take on more risks, their shareholders expect to see higher dividends. The net effect on value depends on that relative size of changes in those two variables. So here's an example. If we assume that two changes illustrated for Procter & Gamble in the preceding example occur simultaneously, and our key variables are D1 is 3.09, R is 0.09, and G is 0.05, substituting that in, we get a share price of 77.25. The result from the decision is an increased dividend growth from 4.6 to 5, as well as required return from 7 to 9%. It's going to be negative. The share price decreased from 128.75 to 77.25. So again, this decision doesn't appear to be in the best interest of the firm's owners because it's going to increase risk more than it does that dividend growth. So what did we learn in this chapter? We learned how to differentiate between debt and equity. The holders of equity capital own the firm. That's through common and preferred stock. Usually, common stockholders have a voice in management. Equities claims on income and assets are secondary to our creditors' claims. There's no maturity date, and dividends paid to stockholders are not tax deductible. We looked at common and preferred stock. Common stock can be privately owned, closely owned, or publicly owned, and it may or may not have par value. There are preemptive rights that allow common stockholders to avoid dilution of ownership when new shares are issued, but not all shares authorized in the corporate charter are outstanding. If a firm has treasury stock, it's going to issue more shares than are outstanding, and some firms have two or more classes of common stock that differ mainly in those unequal voting rights. Proxies transfer voting rights from one party to another. The decision to pay dividends to common stockholders is made by the firm's board of directors, and firms can issue stock in foreign markets. The stock of many corporations is traded in U.S. markets in the form of ADRs and ADSs. Preferred stockholders have preference over common stockholders with respect to the distribution of earning and assets. They don't normally have voting privileges, and they may have restrictive covenants, cumulative dividends, a call feature, or maybe a conversion feature. We looked at the basic valuation models to stock, looking at the present value of all future cash flows and the value of a share of common stock. We looked at specifically equation 6.4 shows us how to find the value of a share of stock by discounting those expected cash flows back to the present value and using that required return with the stock's risk as a discount rate. And although a stockholder can earn capital gains by selling stock at a price above originally paid, what the buyer really pays for is the right to all future dividends. And what about stocks that don't currently pay dividends? Those have a value attributable to a future dividend stream to the proceeds from the sale of the company, possibly. We looked at market efficiency and how quick reactions of rational investors to new information can cause that market quickly to adjust upward or downward. The efficient market hypothesis suggests that securities are fairly priced. They reflect all that publicly available knowledge, and investors should not waste time trying to find and capitalize those mispriced securities. Behavioral finance advocates challenge that hypothesis by saying that emotion and other factors can play a role in those investments. There are three dividend growth models: the zero growth, the constant growth, and the variable growth. They discount future dividends to the present to estimate that stock value, and the constant growth model sees the most used in practice. We looked at free cash flow valuation models, the book value, liquidation value, and the PE ratio. The free cash flow value, values firms that have no dividend history. They might be a startup or an operating unit or division of a larger company. That model finds the value of the entire company by discounting the firm's expected free cash flow at the weighted average cost of capital, or the WACC. The common stock value is found by subtracting the market values of the firm's debt and preferred stock from the value of the entire company. Book value per share is the amount per common share remaining if all the assets are sold for their book value and all liabilities and preferred stock are paid. Again, this is their accounting value, what's in their books. Liquidation value is the actual amount of common share remaining if all the assets are sold for their market value and liabilities and preferred stock are paid in full. So remember, book value is their accounting value, what's on their books. Liquidation is their market value. And then the PE approach estimates stock value by multiplying the earning per share by the average PE ratio for the industry. And then finally, we looked at the relationships among financial decisions that a manager could use to either increase dividends without changing risk. Risk should increase the share value. Any actions that reduce dividends without changing risk should reduce the share value. Holding dividends fixed, any action that increases that risk or required return will decrease the share value. And anything that reduces risk is going to increase the share value. If you guys have any questions on this chapter, please feel free to let me know. We are going to be moving on to chapter 8 next. So again, if you guys have any questions, please feel free to let me know. Hop on office hours or shoot me an email.